So live this Wednesday, December 14th, I'm Shauna Smith along with Dave Briggs. We are just moments away from the Fed's decision on interest rates. Now, Wall Street widely expecting a 50 basis point hike here. Let's take a look at how markets are trading ahead of that decision. You have the Dow holding on to gains up just about 264 points. Taking a look at the NASDAQ 100, that's moving to the upside, up almost 1%. The S&P also still above that 4,000 level. Taking a look at where it traded yesterday, we were right around 4,100 on that two-day chart. That, of course, is going to be a critical level to keep in mind as we look out over the coming weeks. Taking a look at the sector action ahead of the Fed decision, mostly green on the screen. As you can see, utilities leading the way, along with industrials. Technology stocks actually moving to the upside here. Communication services, the only sector in the red. Taking a look inside the NASDAQ, many of the larger tech giants here moving to the upside, with Microsoft up just about 1.8%. And it's also important to keep an eye on the bank stocks. A bit of a mixed picture here ahead of what we're getting in just about a minute, Dave.
Always fun to watch the markets react and then re-react to Fed Day. Let's check out some interest rate sensitive yields as well today. The 5, the 10, the 20. Let's put those numbers up if we can. All right, I'll go ahead and check them out here on my screen. There we go. The 5, you can see just down slightly. Basically, all three of these, very little, if any, movement. A little more in the 30, all really awaiting the words of Jerome Powell and what the decision is. And then you'll see more movement. A lot of focus on the 10 and the 2, a lot of inversion there. The 2 right now basically unchanged as well, about 4.2%. Also, let's check out commodities, very sensitive to interest rate hikes, which we project another 50 points. So let's check out commodities now. WTI and Brent, you're seeing moving up 2%. Let's go ahead and get to Jen Schomburger with the decision from the Fed. Hi, Jen.
Rate hike. The Federal Reserve raising its benchmark interest rate by 0.5 percentage point to a new range of 4.25% to 4.5%. That is the highest level since December 2007. Now, the Fed left in its statement that it anticipates ongoing increases in rate hikes, implying that it will not pause rates in March. Fed officials now see rates rising to 5.1% next year. That's 50 basis points higher than the 4.6% previously projected back in September. Now, that is the median, 5.1%. 7 officials see rates moving higher than 5.1% this next year, with 5 officials seeing rates move as high as 5.25%, and 2 officials seeing rates move as high as 5.6% next year. Now, after that, officials see rates coming back down to 4.1% in 2024, which is slightly higher than projected and goes along with the higher for longer thesis. Why all of this? Officials don't see core inflation coming back down close to target until 2024. And even at that point, inflation they expect to be out about 2.5%, not back down to 2% until 2025 in their estimates. Now, as far as the unemployment rate, they see that rising to 4.6% next year and holding at that level through 2024. All of these higher interest rates means that the Fed sees lower economic growth on average, just 0.5 percentage point of growth next year, and bumping up slightly to 1.6% in 2024. This decision was unanimous. We will get more from Fed Chair Powell at his press conference in less than 30 minutes' time. Back to you.
Yeah, Jed, taking a look at the market reaction to this, certainly well off the highs. All 3 of the major averages for a brief moment trading in negative territory. Jed, a lot of the trading action that we'll likely see over the next 2 hours is going to be based around Jerome Powell's tone, because we certainly have seen volatility going back to the last several meetings, with investors really looking for any sort of dovish tone to really hang on to and to get excited about.
Yeah, I think that the markets are going to have to really cross their fingers. I don't think we're going to see any dovish tone from Fed Chair Powell. I think he is going to be very hawkish. The fact that we see 50 basis points higher than perhaps 25 basis points I previously thought indicates that. The fact that 7 officials see rates much higher than 5.1%, I think also underscores that. We'll see what the Fed Chair has to say. Obviously, they want to walk that line between not crashing the economy by being too aggressive, but it sounds like the recent CPI CPI data that we've had is not enough to quell their concerns about inflation right now.
Fed certainly has a tough job right now. Jen Schomburger, thanks so much. Let's bring in Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. We also have Mike Puglisi, Wells Fargo economist. Victoria, first to you, just your initial reaction to the fact that we did see the 50 basis point hike, but the dot plot rates rising to 5.1% this year, rates 4.1% in 2024. We're now looking at losses across all three of the major averages.
Yeah, so Shauna, I think this is the key point. Two of the things that we were looking at from this meeting is to see where the median dot plot was going to be and whether the word ongoing was going to be left in the statement. So we look at the median 5.1, and remember, that's just the median, right? At the end of the year. That doesn't mean that's as high as they're going to go. It means at the end of the year they anticipate being there. So we could actually see Fed funds go quite a bit higher than that. Looks like that's a strong possibility based on what some of the other members were saying. So I don't think that we can say 5.1 is the ultimate level, but I think having ongoing left in the statement is extremely important. Ongoing usually means they'll continue to see rates not only at the next meeting, but beyond that. So that tells us we've got at least until March with continued rate hikes. We think those will probably be 25 basis points each, but basically all of this is coming in and the market is reading it as we are not done. The Fed is going to continue to raise rates. They're going to keep them higher for longer, like they've said. And even though the market tried to push back on some of that, I think Powell in his press conference is going to remain firm, and the market is reacting accordingly.
All right, Mike, your reaction to the decision and your projection for the terminal rate.
Yeah, I largely agree with what Victoria said. So going into this kind of meeting from the FOMC, what were we expecting? A median dot of 5 1/8, and then around 4% in 2024 and 3% in 2025. That's about what we got. We were expecting weaker economic projections, so lower GDP growth compared to what happened in September, right? Slightly higher unemployment. All of that comes in really roughly as expected. And the idea here really from us is that the Fed wants to see sustained lower inflation prints. It's not just about getting one or two in a row that miss to the downside, but seeing a sustained string of inflation runs that are much closer to 2%. So the recent data is welcome. I think directionally slower inflation argues for directionally slower monetary policy tightening, but there's a big difference between going down from 75 to 50 basis points per meeting and an outright pause, let alone cut. So this is very much in line with our kind of coming into the meeting forecast of, rates get to about 5 1/4 in the spring of next year, and they're left there really for the entirety of 2023. And it's not until 2024 when we finally get some monetary policy easing on the other side of a mild recession.
So, Victoria, on the heels of this ongoing left in this statement, likely higher for longer rates, is there any chance of a soft landing?
I mean, there's always a chance. You never want to say there's a 0% chance of something happening, but I think that chance is dwindling. I mean, you look, obviously we have growth slowing. We've seen that in the numbers. You have a 3-month to 10-year inversion of 83, 84 basis points. To me, that's huge. We don't have the positive real rates that we want to see that would help us have that soft landing. And look, I mean, we have earnings coming up. Earnings expectations are continuing to fall. And if you have prices coming down, but yet you have wages staying stagnant, you've got to have productivity in order for earnings to do well. And we're just not seeing productivity either. So wrapping all of these things up, along with a higher Fed funds rate, I think you're leading yourself into a recession sometime around the middle of next year. But I do think it'll be somewhat shallow because you've got a consumer that continues to spend. The Fed wants that demand to go down. Demand is not declining. It's just kind of being reallocated from goods into services. So I do anticipate we have a recession in the middle of next year, and then we'll bounce back probably towards the end of next year, ready to go into 2024.
Mike, your recession prediction, I do want to circle back to the consumer in a sec, but first, do you agree with that assessment? Middle of next year, a mild recession?
I do. And that's more or less our forecast as well. So a recession that starts in the middle of next year, maybe lasting a little bit longer so we don't have unemployment peaking until early 2024. But, financial markets very well may move in advance of that. Again, not particularly deep, an unemployment rate that peaks at 5.5%. So call it a couple percentage points above what we have now, but nothing like what we saw in 2020, 2008, 2009, when we had unemployment of 10% plus. I do still think there's a path to a soft landing. It's not our base case, but we often talk, I think, about the economy like it's binary, right? Either times are great and there's no recession, or times are terrible and we're in one. And I could envision a scenario where we got weak but positive growth next year, still above zero, maybe job growth that flatlines but doesn't meaningfully contract, and we get inflation, to 3% or a little below 3%. Again, that's not our base case, but that does strike me as a plausible outcome for a year from now.
Mike, the consumer has been very resilient, like Victoria was just saying. Are you expecting that scenario or that trend to begin to shift as the economy does potentially continue to weaken?
I do. Consumers are still in a pretty good place, right? They've seen rising debt levels, rising credit card usage, but off of low bases. Job growth continues to be pretty solid. There's been some near-term relief here as, we talk so much about core inflation, but headline inflation's really slowed a lot off the back of much lower energy prices. And, we won't get the December CPI until on the other side of the holiday season, but it looks like that's going to be fairly weak as well, just based off where we're trending. So there's some near-term relief there on headline inflation and particularly energy prices. Job growth is still good. Wage gains have been solid. But as I do think as we get, deeper into next year, you'll see a little more consumer weakness as those excess savings are burned off, as credit utilization has gone up, and as job growth continues to slow. It started the year at 500,000 jobs a month, and we've seen it go from 500 to 400 to 300,000, now into the 200s. And I think that slowdown will continue into next year. And alongside, I think you'll see much slower consumer spending growth.
Victoria, a little closer look for you at the consumer. Can they continue to spend through this?
Well, so far they have, Dave. I mean, we look at what they're doing, and you can look at the consumer in two different categories. We have that higher end consumer, and they still have some of that money in savings, some of those stimulus payments that are there. So they've still got a little over $1 trillion that they can still spend. You look at a lower end consumer where perhaps they've gone through that savings a little bit. As was mentioned, credit card usage is going up. But when you have gasoline prices coming down, that's a much larger percentage of the income for that lower income spender. And so with those prices coming down, that gives them a little bit more to keep going. Obviously, here in the fourth quarter with the holidays, there's more spending than usual. People stretch themselves a little too far, probably. So I think we'll get good numbers this quarter. As we go into next year, then yes, I think the slowdown is there. Consumers will get a little more picky. Pricing power is going to be key for corporations to see who can keep those consumers and keep supporting those balance sheets. But I think we'll see a slowdown next year, but not completely going away.
Victoria, what does all this mean for investors? And I guess in particular, what do you think investors are going to want to hear or waiting to hear from Powell this afternoon?
Well, probably people want different things. I mean, financial conditions have been easing, right? We look at mortgage rates coming down, which supports housing, the dollar, which supports exports, dollar coming down, credit spreads coming in, which means CapEx is being supported. So I think they're going to be looking to see, is Powell going to push against a lot of this? If so, then I think that's going to be even more concern for that higher for longer thesis, that Powell is very adamant in pushing that Fed funds rate higher. So I think they're going to listen for that. How much is he pushing him back against easing financial conditions? Obviously, they want to see if there's any foreshadowing for the February and the March meeting. The market likes to look ahead and try to see what it can determine from parsing his words. So there'll be a lot of that as well. And I think one final thing they'll be looking at is what information is he going to give about quantitative tightening at this time? That's kind of been in the background for a while, but as they come to the end of hiking Fed funds rates, then quantitative tightening will be more in the forefront, and we'll want to get some more information on that.
Certainly will. Investors will be looking for any more detail that we can get, especially the tone that's coming from Fed Chair Jay Powell in just a few minutes from now. Victoria Fernandez, Mike Puglisi, thanks so much for joining us. Let's take a look at where things stand here in the market. All three of the major averages right around their lows of the day, down now off 143 points. Jared Blicker has a closer look at some of this reversal that we're seeing, Jared.
That's right. And some of those mega cap sectors getting hit the hardest, and we'll get to that in a second. Here, I just want to show you the Dow had been green for most of the day, not anymore. You can see it gave back all those gains and a little bit more. And the NASDAQ suffering even more than the Dow. That's down 64 basis points, gave up then some and even more to a greater degree. I'll put it like that. Here's our sector action for today. As I was saying, communication services is the worst performing sector. That is the sector that houses Meta as well as Verizon. But really some of those big ticker names that have fallen off the most this year are represented not only in communication services, but consumer discretionary and to a lesser degree tech. So not surprising that these are underperforming. Now, what's in the green? Healthcare and staples. So that's a defensive setup. Now, I'm going to go to the S&P 500 futures over the last 2 days because I want to point out something important. This was that big spike up that we got on CPI yesterday. That was at 8:30 a.m. We gave it all back yesterday, came back into the green today, but we are now below that CPI print. And I point this out in general. I want to go to year to date. This is kind of no man's land right here from, let's say, 3,900 all the way up to 4,150, 4,200. That is a neutral zone for the S&P 500. A lot of traders going to be watching for a break of this range. Until that happens, this is mostly noise. Now, a couple other charts here. Want to show you what's happening in interest rates. We got the 10-year Treasury note futures going down. That means the 10-year T-note yield is going up. That's as we would expect for something that's being perceived as slightly hawkish here. Here's gold heading down. We can see also even WTI crude heading down just a little bit. And for something that seems to be the most highly levered to the Fed's balance sheet, Bitcoin, guess what? Bitcoin heading down as well. And I think we're going to be keeping an eye on this. At least I am, because this, as I said, having been the most levered to the balance sheet, also the most sensitive. So right now, I'm going to be watching Bitcoin to see what the tells are in the presser here, guys.
Yeah, sure was interesting seeing it above 18 earlier today when everyone expected the floor to drop out of Bitcoin. Jared, thanks so much. All right, now we're joined by Dartmouth College economics professor and former Federal Reserve Board special advisor Andrew Levin. Nice to see you again, sir. First, your reaction to the decision by the Fed and the language.
Yeah, I think that what's great about the Fed's communication is they have the statement, which almost zero changes today. There's literally like 2 words that are minor. Of course, the actual change in the funds rate. But what's important is the new projections that they've released and some pretty notable changes since September. What I would emphasize here, and somewhat distinct from the previous guest that you were speaking with, is I see the risk in a different direction going forward. The latest Atlanta Fed assessment is that GDP for this quarter is going to grow at around 3%, which is well above the kind of normal sustainable rate. Unemployment rate's still low. Jobless claims will get a new batch tomorrow, but they're still running very much like normal. The financial conditions have eased a lot. What I think could happen over the next 6 months to a year is the economy continues to be pretty robust and resilient. Business fixed investment continues to expand. Retail spending holds up pretty well. And in that world, workers still want cost of living increases. Nominal wage growth can continue high. And that's going to lead to continued pressure on prices in the service sector. So what the Fed's alert to, I think you can see it now in their dot plot, is they got a ways to go. There's a benign case where inflation comes down a lot next year, not just in goods, but in the service sector and in nominal wage growth. But I think the scenario investors should be alert to is the possibility that even going above 5% isn't enough, that the economy is going to more or less continue humming along next year, and that it's going to turn out the Fed has to go further.
So, Andrew, how much further then do you think the Fed is going to have to go? If 5.1% isn't high enough, how much higher do you think is necessary?
Well, so the Cleveland Fed has a new survey of inflation expectations of consumers. They asked ordinary people kind of how much of a wage increase would you need over the coming year in order to compensate you for the cost of living. And the answers in those surveys are on the order of 7 to 8%. That's pretty consistent with some other measures too. The nominal wage growth is very strong right now, 3 percentage points above the pre-pandemic levels. So if you ask me, where does the Fed need to go if the economy continues to be strong next year? I'd say 6, 7, maybe more. We'll see. We're in uncharted waters here in the wake of the pandemic. So we should be really careful here just to recognize that there's a lot of distinct risks, and we should be alert to those risks.
I just want some clarity. You don't think the Fed will go to 6 or 7%, do you?
I think there's a very good chance of that. In fact, I will tell you, a year ago, I was on this program at a time when most professional forecasters and market investors thought the Fed would only hike once or twice this year. And I said a year ago that I thought they might have to go up to 3 or 4 or more. And you and your colleagues were kind of in shock. And I think, but looking back, it was clear the risks were to the upside. So I just want to say again here, we'll look forward over this coming year, and they could go in the other direction. But right now, I don't see the risk of recession as nearly as significant as the possibility that the services inflation continues to be far higher than the Fed's target.
We'll check the tape, man. We believe you absolutely, Mr. Levin. But I'm curious, there are some who feel the Fed may be forced to call it a victory around 3.5% to 4%. Do you think that's possible?
I think if inflation stays high for another year, and high here could be 4%, that would still be twice as high as their target. Then we get into a presidential election year, and the Fed's going to be in a tough spot at that point a year from now. Are they going to be willing to tighten a lot further and potentially cause a recession in advance of a presidential? That would be a really tough decision to make. So the possibility that this gets further and further entrenched for the next several years is definitely part of the concerns that I have.
So, Andrew, where do you stand then on the labor market? How much job loss or weakening we need to see on that front, if any, in order to get inflation under control and to be in a better position than we are today?
Okay, that's a great question. And I think one thing that's important to recognize is that when the job market's growing steadily, and right now, the what we call prime age workers, which are people in their 25 to up to around 55 or 60 years old, most of them are back to work now. The ones who were working before the pandemic now, most of them are back to work. In that sort of environment, we shouldn't be expecting to see job growth of 200 or 300 or 400,000. The normal kind of job growth that you need to have to sustain the labor market is probably more like 100,000. So my expectation is we should and almost have to see job growth declining over the next 6 months, 9 months to around 100,000. And we should not view that as a tightening of monetary policy or a sign of a recession. It's just going to be the normal pattern of, at this stage of a recovery, what happens to the monthly job numbers.
What would you like to hear from the Fed chair today?
If he keeps reinforcing the message that they're not done and that they're willing to do what it takes to bring inflation back, they got to be careful. They ideally would like to avoid a recession, or at least a severe recession. They should take a balanced approach to both parts of their legal mandate, maximum employment and price stability. But given that services inflation is heading still in the wrong direction, we need to hear from Chair Powell reinforcing, underscoring that commitment month to month to month to month until we really see progress on this.
Andrew, when it comes to raising rates, how quickly the Fed could potentially do that? You said that maybe we'll see somewhere around 6 to 7% outside, or I guess looking ahead to next year, the next Fed meeting. Are you expecting another 50 basis point hike, or how do you see them getting to that potential 6 to 7%?
I think that's a good question. So they're alert to the data coming in, and some of the data around the holidays is harder to read. But I think that probably it would make sense for them to make another 50 at the end of January, given what they've just shown in their dot plot today. I think if they didn't do another 50, it might undermine their credibility. But going forward beyond that, they could start moving to 25s. Or if the service inflation data is continuing to come in stronger and the nominal wage growth going into the new year looks like it's picking up, even accelerating, then they'll have to keep doing 50s for a while. And again, the communications here is really critical to keep updating the public and the markets how the Fed sees all of this.
Andrew Levin, always great to have you. We're going to have you back here in order to follow up on today's projection. You were right last time. We'll see if you're right this time around. Thanks so much for joining us this afternoon. All right, let's get to check in on the bond markets, because as equities fall, we're seeing yields move to the upside. 10-year yield now up just about 4 basis points at 354. 30-year yield up about 5 basis points. We want to bring in Gurpreet Gill, Goldman Sachs asset management macro strategist for global fixed income. Gurpreet, great to see you here. So just first, your initial reaction to what we just got from the Fed.
Hi. Well, first of all, thanks for having me on the show. In terms of the meeting outcome, I would say it's very marginally hawkish in the distribution that we saw around the 2023 median projection. The median was expected to go to 5.1%, and that is what we saw, but we've also seen a higher median projection for 2024 and 2025 as well, so this higher for longer environments. In terms of small tweaks to the statement language, they could have also indicated that there would be further rate hikes, but the language still says ongoing. And so the Fed is making very clear that even though they are stepping down the pace of rate hikes, they are not stepping back from this task of taming inflation.
Is it your expectation we'll get 2 more 25s and a hold?
That is our base case expectation at this point, but we're still in this post-pandemic economy where the data is incredibly volatile. As your last speaker just said, it can be particularly volatile around this holiday period as well. But we still need to see that rebalancing of the labor market to ease wage growth and put services inflation on a sustainable path downwards as well. We're not yet seeing that. So I would say the base case expectation is still for 225 basis point rate hikes after today's 50 basis points, but we have to be very data dependent, just like the central bank.
Gurpreet, what do you think of the bond market reaction so far? The 10-year yield up just about 4 basis points this afternoon. What does this signal just in terms of the action that we could potentially see in the coming weeks?
Well, for bond markets, I would say this could be somewhat of an unwind of the reaction that we saw to inflation moving in the right direction, and therefore expectations for perhaps a slower pace of tightening ahead or a sooner pause. And so I wouldn't read too much into the moves immediately. And I would say big picture, there's 3 important takeaways for the bond market or fixed income investors for the year ahead. The first is that bonds are back, or bring on bonds. The higher yield means that it's the most opportunistic environment for income and total return in more than a decade. But the second thing is really important, and that is that the first statement I just made is far too simplistic for this very complex world that we live in. We're still working through the impacts of the pandemic. The global economy is going to be dealing with the aftershocks of the war in Ukraine, particularly in the energy market, for years to come. And we're heading into 2023 with growth slowing. Earnings is going to start to slow, and so it's going to be much more dispersion. So the second key takeaway is be highly selective in this environment. And then the third key point is related to that, and that is right now, quality comes first. And so we have an up in quality bias when we think about the fixed income spread sector. So we like investment grade bonds, we like agency mortgage-backed securities because they tend to be less cyclical as well.
Not sure if you heard our prior guest, Andrew Levin, former Federal Reserve Board Special Advisor, who said he believes rates will go well north of 6, potentially as high as 7. Your thoughts on that?
Well, I would say, like I mentioned, we're still in this economy where we're trying to work through the impact of the 2 big shocks that we have felt. There are reasons to believe that inflation will settle at higher levels than it has in the past. It's not quite clear yet what that means for the terminal rate and how stable that will be. If we take a sort of step back, coming into 2022, the market expected the Fed's terminal rate to be 1.6% for this cycle. Now it's around 5%. And so a lot can change depending on how the data evolves. And so we'll have to wait to see, does inflation move back down towards 2% and sort of over what time horizon? There is so much uncertainty around the magnitude of those declines and the timing. My best guess would be that inflation is going to start and continue that process of normalization over the coming year, but it's going to be still much above 2% by the end of next year.
Gurpreet, do you think the Fed is going to settle for something higher than 2%? Because I think that's the big question being debated right now on the street, whether or not 3 or potentially even 4% is going to be good enough. Does that work for you?
I would say the Fed undertook a strategy review prior to the pandemic, and it unveiled its flexible average inflation targeting framework. If you were to really take that at face value, they would have to be targeting inflation well below 2% to average 2%, or it just literally wouldn't be possible. I would say in the near term, changing the target before you've even got close to it would damage your credibility. And so I didn't expect the central bank to change its target anytime soon. But I do think as we start to settle into a new regime, central banks and academics and others in the markets alike will begin to consider what is the appropriate rate of inflation for this economy that is not just dealing with the aftershocks of the pandemic and war, but you've also had long-term themes fast-tracked. One of those is just this rewiring of globalization. It's no longer just driven by cost and efficiency. Globalization is now driven by supply chain resilience, by sustainability, and by interests of national security. And so all of that does point to a structurally higher inflation regime than we saw previously.
And Mr. Levin made a great point that at some point in the near future, we're going to run up against a presidential election, which changes the equation, certainly for the Federal Reserve, even though they certainly don't want to admit that. So what would you like to hear from Jerome Powell today? Do you expect to hear more about QT and mortgage-backed securities we've heard very little of?
Well, what we would like to hear is more about what the Fed's thinking and what it is taking into consideration. And so what's helpful for us is to know what are the key data points that they are looking at. How is their assessment of the labor market evolving? We saw in recent speeches that Chair Powell has placed focus on the jobs workers gap framework. So looking at how many available jobs there are to workers, and the big hope for the soft landing scenario is that you rebalance the labor market by having new job openings come down, but you don't necessarily have a large rise in layoffs. And so it'd be interesting to see if he alludes to any other data points or, excuse me, what other data they've interpreted over the past month or so.
Gurpreet Gill, Goldman Sachs Asset Management. Thanks so much. Terrific stuff from you. Shauna, as we wait the words of Jerome Powell, should be just a couple of minutes now. What is your expectation? What are the words you're watching for? I'm looking for the word longer, tighter and longer. I expect a very hawkish Jerome Powell, but I think he's been remarkably consistent.
He has been very consistent. What's going to be interesting, so this statement is clearly very hawkish, and we see that reaction playing out in the market right now. Last time the Fed met, and the last time we got a decision, the statement read relatively dovish, or at least that was the market's initial interpretation of the statement. And then we had a hawkish Jerome Powell. So it'll be interesting to see whether or not the tone of the statement matches up with what we are going to hear from Powell in just about a minute or so. We know the market loves to latch on to any sort of dovish tone that we could potentially get for him, but he has remained very consistent, saying time and time again that the Fed will continue to raise rates until inflation is under control. That 7.1% print in November, clearly a huge improvement when you compare it to what we had been seeing in prior months, but still ways to go to get to that 2% inflation target that at least the Fed continues to have.
Still trying to digest Andrew Levin with the prediction of 6 to 7%, but it's hard to argue against that logic. I think it's either that or we do settle in at a rate 3.5%, 4%, and the Fed has to call a victory. I hadn't actually thought about the likelihood of running up against a presidential election, was a good point. As for a wild card today, I hope there's a question about Bitcoin and about what his read of that is. And FTX, I'm not entirely confident we get it, but any wild cards you're looking for?
It will be interesting to hear that. I also think people will be closely listening for anything he has to say about the weakening that we are seeing in the housing market and what that means for the economy. All right, Fed Chair Jerome Powell is live now. Let's go to him.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the 5s. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick. Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's SEP?
No, absolutely not. No, as just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel?
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see that, you see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You know, you can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases, we want strong wage increases, we just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, you know, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael,
excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's, inflation, 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. we're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that with structural labor shortage is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't. Talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right, there you have it. Fed Chair Jerome Powell wrapping up his last press conference of the year before the next meeting, of course, next year, post-Christmas. No real surprises there whatsoever from a remarkably consistent Jerome Powell for the last several months, kind of reiterating where the trouble is, where the stickiness is. Check on the markets here. They reacted positively momentarily, not entirely clear to what. But look, nothing really stands out here other than, Shauna, remarkable consistency, price stability, a commitment to 2%, and staying in restrictive territory, sticking to that 5.1 number. Nothing should have surprised the markets today, at least from my estimation. You?
No, exactly. We know the Fed remaining very hawkish, the tone pretty consistent with what we heard from the state, or what we got from the statement when it comes to the Fed, comparing that to what we just heard from Fed Chair Jay Powell, saying that we still have a ways to go. The language keeping pretty consistent. Powell saying that we're not at restrictive enough a policy stance yet. Can't say confidently that we won't move up peak rate estimates here. Labor market remaining extremely tight, something that he touched on a number of times during that press conference. For more on the press conference, we want to bring in Brian Belsky, BMO Capital Markets Chief Investment Strategist, here on set with us today for Fed Day. So
this is exciting.
This is very exciting.
Live in
The
New York.
excitement's all over here, all on our side, sir. And spectacularly dressed, may I say.
Very,
I mean,
well dressed. You
choice.
dressed the part today.
Thank you so much.
Well, let's start with what we just heard from Powell. 50 basis point hike, 5.1% rate by the end of next year, much higher than what we had initially maybe anticipated. Stocks initially dropping on that news. What do you make of it?
I'm going to go OG on you, kind of going back to the sports, use the sports analogy. You'll like this.
Please, I will. I'm listening.
So it's a Alabama football game. They're playing my alma mater, St. Cloud State.
Ooh, this could be ugly.
Yeah.
Tough matchup. Not a good
It's
start.
40-point spread here.
It's 81-3 with about 5 minutes left, and Saban's going for 2. So what's the analogy? We know what the outcome is, right? The Fed's going to win, and Alabama's going to win the game, and they're just pouring it on here a little bit. And the Fed, to me, and to the market, especially when the announcement came out, and he calmed some people down, calmed down a little bit during his comments, but they're going to follow the traditional Fed script and go too far. Everybody, we know this. So over-tighten. And the Fed, the market and the economy especially, is being stubborn. And we've said for several years on your program that, that we're really good at a lot of things in the United States, but one thing that we're really good at is spending money. And I think some perspective needs to be added to this. If you go back a year ago, and I remember I was in December the first couple of weeks, I was in New York, the first couple of weeks in December, and then we had lockdown again from Omicron. We'd never really had a chance to live and be out there and do what we do in December, which if you've been in the city the last couple of weeks, it's been nuts. And so I think this is going to continue. And be that as it may, there are people worried about inflation, but we are seeing the signs of inflation rolling over. Now, the Fed does not meet until February. What if January and February, we finally get month-over-month declines in CPI? I think that's why the market did what it did yesterday, didn't hold on to its gains. And whether or not you want to buy the rumor, sell the news, whatever happened yesterday happened. But clearly the escalator down in inflation is beginning. What we really need to see is the elevator down, and I think the elevator starts going down when we see month-over-month declines in CPI. So the Fed is saying, you know what? We're going to defeat this thing, but let's really defeat it. And doing what it usually does is go too far.
He's been clear they would rather over-tighten than come up short. But the difference with the football analogy, which I love, by the way, we know when that game's going to end. We know when Alabama's going to crush your alma mater. It's not entirely clear when Jerome Powell's going to win this and get inflation anywhere near 2%.
It's a wonderful way to put it, and frankly, and we've said this the last 6 months or so, we've been wrong. We thought that inflation would roll over a lot faster, and it has been stubborn. And I think the Fed has recognized that as well, that it has been stubborn and continues to be stubborn with respect to inflation. But the tide is beginning to turn. We are starting to roll over, and the rest of the world is slowing down too in terms of its economy. That's why even with this, stocks lead earnings, which lead the economy. Market was down 25%. The next shoe to drop is potentially earnings, but not to the tune of 20% like most people are saying. It's going to be less than that. And I think that, along with comments and things like happened today, we're still involved with a momentum and reactionary market. And that's why you're seeing these these reactions here, but I really believe, and our work shows it in terms of the fundamentals of the United States stock market, we really believe that U.S. equities are the most stable equity asset in the world, and we do think flows are coming back to the United States. And what's really interesting to me doing this now for my 33rd year, and I started when I was 9, Doogie Howser of Wall Street. People don't know that reference anymore. But I've never seen cash flow prowess, I've never seen balance sheet strength, and I've never seen earning stability like I have right now across the market cap spectrum, from small, mid, and large. That's why we like small, mid going into 2023. Be that as it may, I do think we're going to see some volatility because it's not going away, especially in the next couple of months. I mean, we don't have a Fed meeting till February. Let's think about what we could see by then. We're going to see fourth quarter and year-end 2022 numbers from earnings in early January into February. Then we're going to start hearing more about real definitive forecasts for 2023, which are going to be squishy. Remember, we have reared now an entire generation of CEOs that underpromise and overdeliver and kind of are more conservative first. And I think they're going to be probably a little bit more conservative into their 2023 earnings. And that could make the market a little bit squishy the first couple of months of the year. I don't think it's going to be the full first half of the year. I think you probably have a better buying opportunity. I don't like to time the market very early on in the year. And I do think that we are higher by year end next year.
How much higher by year end? And more specifically, when you're trying to identify certain opportunities, are you looking for those beaten down names from this year? More specifically, maybe some of those tech or communication services names that have really lagged the broader market?
We are overweight communication services. We think it is the quintessential barbell sector and kind of pair trade sector. You know, we added Netflix to our value portfolio when it got beat up in May, June. So we like Netflix and Google, and then on the other side of the kind of the barbell, AT&T and Verizon, and Disney actually now recently has become more of a value type name. But we're not buying the long duration, high multiple assets with respect to tech. In our technology holdings, we're kind of matching up. So let's just talk about semiconductors, for instance. NVIDIA, we match up with Qualcomm in the portfolio. And so we don't want to have just the high multiple stuff. We want to match it up with a lower multiple kind of value-ish type tech. But to answer your question, I think we're entering into a prolonged period of more normalized trading. Everyone's been talking about normal. We've talked about normal now for 6 months. I think the path to normalization is a lot of things. It's high single digit to low double digit performance in the market. It's single digit earnings growth. It's 3 to 4% 10-year treasuries and 2 to 3% GDP. That's a pretty good environment for stocks. I think that's what we're going for the next 3 to 5 years in Canada and the United States, by the way. And so that stability, I think, will really draw investors back here. And then we'll see reglobalization and things like that. But onshoring and reshoring is a major theme. We wrote about it last week, and that's why we want to focus more on domestic names, and so therefore small, mid, and more value-ish over the next couple of years.
And because of that setup, you're underweight where and why?
Utilities and consumer staples. So, you know, people always say, Belsky, I have an opinion about everything. Well, one of the opinions that we have that is actually quite contrarian is we do not believe that utilities and staples are defensive. Now, on page 72 of your Rutgers
manual
on investing, it says, be defensive and buy staples and utilities. But what our work shows is that the relative multiple, not just earnings, cash flow, not just earnings, but cash flow and sales, the relative multiple on consumer staples went up in 2022, the most it's ever had in history. And from a stability standpoint, their earnings are no longer stable. In fact, technology companies in totality are more stable in earnings than staples. No longer defensive, okay? So your Campbell Soup, your General Mills, you know, the end of the world's coming, you have to have your, you know, Cinnamon Toast Crunch. But on the utility side of things, utilities, people complain about long duration assets being technology, but if you take a look at just multiples, right? The multiples in utilities are very expensive. So I don't see those as defensive names. Now, what's going to end up happening is we'll have some softness in the market. You're probably going to see one more spike in utilities and staples. That's going to be a beautiful exit point. So those are the names we think you should be avoiding.
Well, Brian, then given that investment thesis, where do financials fall? Are you still seeing opportunity there? And more specifically, I guess, what do you like when you compare some of those larger banks to some of those more regional plays? We love the larger banks because of the multi-divisional asset parts of their businesses, meaning some quarters wealth management work, some quarters capital markets work, some quarters the commercial bank work. And I think the regional banks are going to be a little bit tougher
especially given the balance sheet opportunity of a Bank of America or even the Canadian banks coming down with the big balance sheets to do commercial banking loans. We also like small mid-cap financials like Raymond James and LPL because the brokerage businesses have been very strong. And remember, too, that brokerages do very well in a rising rate environment because, believe it or not, investors still trade on margin in the United States especially. And so the spread with respect to that they can charge on the interest rate side goes up, and those companies' earnings have been very strong. So we love financials. We think financials are the quintessential value sector heading into 2023. Healthcare looks very good as well. However, we've started to see some healthcare deals, and that worries me a little bit. And also, I think everybody's there, and they're kind of using that as kind of their growthier momentum area. And biotechs obviously have done terrible in the beginning of the year, but now they're doing a lot better. So from a multiple perspective, again, looking at cash flow, earnings, and sales, they're still below historical norms, but we've seen a big spike in how they've been valued. So we're overweight. We're just a little bit more selective. We like kind of life science companies, some drug companies, and some device companies.
St. Cloud State's finest, BMO
Thank
Capital
you.
Markets.
It's an honor.
Brian Belsky. Let me just drop an early Merry Christmas on you.
Merry
That's
Christmas
the first
to
time
you.
I've said that, but we'll see you next year.
Thank you so much. We appreciate it.
Great to have you here.
You got to
sir.
join us back in studio again.
Yes, mid-January.
There we go.
January, he's booked.
Have you on the tape saying that.
Leave that jacket around for me. I appreciate that.
Thank you.
All right, coming up, plenty more here on Yahoo Finance after the break. We'll have more on the Fed hike, plus Delta Airlines raising its fourth quarter earnings guidance. See why the company's CEO believes momentum is building heading into 23. Then today's rate increase will have a major impact on mortgage rates. Zillow's senior economist tells us what it means for home buyers. And find out why the Justice Department and the SEC are going after 8 social media influencers. Don't go away. All right, more on the big Fed rate decision. Let's check back in with Jen Schomburger to get her key takeaways from the Powell speech. Jen, what stood out to you?
Hey, good afternoon there, Dave. Fed Chair Powell walking a very hawkish line at the press conference, saying he couldn't confidently say that Fed officials wouldn't raise their estimates for rate hikes at the next meeting. Remember, the Fed officials just raised their estimates for rate hikes up to 5.1% for next year, and that's just the median estimate. 7 officials see rates moving higher than that. 5 officials seeing rates move up to 5.25%, and 2 seeing up to 5.6% next year. He says, that, of course, that the SEP does not represent a plan and nobody knows with certainty. He says the focus now is on moving policy stance to one that is restrictive, and they are not whatsoever considering rate cuts. He says he wouldn't consider rate cuts unless he is confident inflation is coming back down. Now, as for the growth forecast, Powell was asked whether their growth forecast of just 0.5% of growth next year basically constitutes a recession. Powell turned that down flat, saying it's still positive growth, and it's really tough to know whether what the odds of a recession are. I asked the Fed chair whether committee members discuss how deep of a recession they'd be willing to take in the midst of these rate hikes. Take a listen to what he said.
What we do is we make our forecasts and we publish them quarterly. And you know, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course. We don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades.
As for the next meeting and whether the Fed could slow down the pace of rate hikes even further to perhaps 25 basis points, Powell basically saying he hasn't made a judgment for that meeting. Everything is going to be made on a meeting-by-meeting basis and will hinge on incoming data. He says a big part of this will be looking at wages moving back towards lower levels. Back to you.
And Jen, how important do you think the labor market is in all this? Because clearly it was a theme throughout the press conference. Powell, time and again, reiterating how tight the labor market continues to be, and the layoffs that we more recently have seen, specifically within the tech sector, that's more of an industry-specific problem rather than signaling really what's going on overall in the labor market.
Yeah, Shauna, to your point, Powell saying that the labor market's still very much out of balance, and it's going to take time for that to correct. And when that does, wage pressures will correct. But until that time, he does see wages remaining elevated and tying into this inflation scenario that we're seeing. He expects inflation to still remain elevated going into next year, but they do expect substantial progress as we go through the year. He welcomed the news on the CPI reports in both October and November, but says that that's just 2 months and there's still substantial progress that needs to be made.
All right, excellent work once again. Jen Schomburger, thanks so much. Markets moving quite a bit, as you might expect, and you can see the Dow, really the move. We've seen about a 400-point move from the point that just before we heard about the decision, and the NASDAQ has moved out about 200%, but 200 points rather. The S&P is probably the outlier a little bit, not as much movement there. So let's get into this and talk a little bit more about it with Joyce Chang, JP Morgan's Chair of Global Research. Joyce, nice to see you. Like to always start with the blank slate. What stood out to you either from the Fed projections today or the language from Jerome Powell in the press conference?
Well, the first thing is that the markets really had been getting ahead of themselves. I mean, we did see that core goods prices came down more than expected, but core services were up wage inflation, rent inflation were up. So what stood out was, that the Fed is going to hold the line here. And I think that the market was getting ahead of itself. It was pricing a recovery before the recession had even occurred. So, I'm not surprised. We still think that, there's more to go. We don't see a pause until the end of the first quarter of the year. We see two more smaller hikes still forthcoming, and I think that Powell has signaled very much that labor market conditions, wage inflation is something that is of concern. So it wasn't. It was very much actually in lines with what we had been thinking would occur. We thought the market action in the run up to this was probably getting ahead of itself.
Joyce, when you take into account what Powell said, remaining committed, that 5.1% median target here for rates next year, what we're getting from officials, the risk here of going too far and what that means in terms of the odds of a recession, whether or not that's a sure thing.
Well, in our forecast, we have a recession, but late in 2023 and a mild recession. And we do see that the labor market could shed 1 million jobs. So I think that it's very possible that you could see the equity market also test the lows sometime in the first half of the year. But we are looking at a mild recession. So if you call it a hurricane, it's a Category 1 hurricane. But we do see growth slowing down. And that labor market conditions will need to adjust, and the unemployment rate will need to come up. So I think that markets have been pricing in and really getting rid of the tail risk of going to 5.5%, and that risk is still there. And I think Powell's made it very clear that it's very dependent on the data that they see in the coming months.
Yeah, Joyce, if there's any real difference today from the last several press conferences, it was really that emphasis on what he said, Jerome Powell, that third basket, services, the labor market, wage growth. When do you think the Fed will begin to see their work pay off in that regard? Because we clearly have not seen it.
No, look, I think that is that you could be well into 2023. So, we don't see, a Fed pivot, really being under discussion until later in the year, and that may not occur until 2024 as far as the Fed ease. So I think the market had been, pricing in a lot, looking at, just the core goods, like the fall in used car prices. But you take a look at core services, you're still far away from target there. And I think that, rent was actually very noticeable, not just, wage inflation pressures, and you still have very tight labor market conditions. So I would just say that, you've got to really look at this as more of a long game. The market has moved a lot just over the last month.
Joyce, what does all this mean in an aggressive Fed in terms of earnings estimates for next year? Because a number of those estimates have come down, but should they be revised even lower from where they are today?
Well, we have cut our earnings forecast for the 2023 S&P 500. We actually took it down to 205. So that's on weaker demand and pricing power. And one of the key things we're looking at is that this household savings cushion, this excess savings, household savings that we had that really kept consumer spending up strongly, we think that that will dissipate by the second half of the year. That's going to lead to further margin compression. We also see lower buyback activity, down probably about 25% in 2023. And this is one reason why we don't think it's out of the question that you could test the lows again. And we also think that the macro vol is going to remain high here. We expect volatility to remain above its long-term average, with the VIX averaging around 25 in our baseline scenario for next year.
Geopolitical events certainly will continue to play a role here. What's your expectation as per China's scaling back on COVID-0 and their reopening and their growth moving forward?
Well, we have seen a rebound in China equity markets since early November. And the reopening, we thought it might be the spring, but they're clearly moving that up. And they came out recently with 10 new measures to really ease some of these COVID restrictions, which I think they were under great pressure to do. The economic numbers for this quarter had really shown a big collapse in the export activity. You've also had more of the social protests. So I think officials really had to act to do something. So they've announced a number of measures, and in the coming weeks, as we head towards the Lunar New Year, I think the markets will watch whether the government will officially downgrade the risk level of COVID from level 1 to level 2. They're going to take a look at the cross-regional travel, whether that can be normalized around the Lunar New Year, which falls earlier this year, around January 23rd. And I think that there's also, that you will see like a lift to, economic activity, I think for the later part of December and January. But the numbers that had come out quite recently had really shown a big collapse, a plunge in exports, like mobile phone exports down 30%. So I think that some of these market moves, the government moves have been in reaction to just the economic numbers that printed recently.
Joyce, when it comes to where you're seeing investment opportunity, what this all means in terms of your projections next year for equities, what are you doing right now?
Well, I mean, we're overweight healthcare. We think that this is a defensive sector that does well, even if you do have like a rise in bond yields. We like utilities over real estate right now. We're neutral right now on financials and tech, and where we're underweight is on the industrials because of the slowing economic cycle. Very recently we put in a tactical. Now it's tactical because we still have a long-term structural bullish view on energy, but just given the the power of the rally that we've seen over the past year, we do have a tactical short recommendation on energy right now.
All right, Joyce Chang, always great to get your reaction. Thanks so much for joining us this afternoon.
Shauna, thanks, Dave, and happy holidays.
Thank you. You too. Well, coming up next, Verizon is offering free Netflix for a year to new and existing customers, but there's something that you're going to have to do first. We'll tell you what it is when we come back. Time for our triple play. 3 stocks that we're watching in the final 15 minutes of trading. We have Charter Communications, Caesars, and Verizon. Josh Schaefer joining us here on set for this. Well, my pick today, Charter Communications. The stock is sinking, falling the most since 2020. You can see shares off nearly 16%. All this is because of concern about a boost in spending. Charter Communications announcing a large-scale expansion to upgrade its infrastructure for higher-speed broadband, and it's going to cost a lot more than what the street had initially anticipated. Charter Communications sees that its capex rising to $9.1 billion this year and $10.5 billion next year. That's about $1 billion more than anticipated. Initial reaction from the street, obviously not a huge surprise given the boost that we are seeing in spending. We'll see whether or not it pays off for the company.
Yeah, Shauna, and Charter also a company that missed on EPS estimates by about 10% last quarter, and that dragged on the stock then. So I think investors sort of hoping that they maybe be spending a little bit less here, but we'll see how that investment turns out, right? Now, my play today is 2 gambling names, Caesars and Penn Entertainment. Bank of America downgrading both those names from buy to neutral, setting diminishing in the softening consumer demand, flattening gross gaming revenue, and declining visitation. Now, take a look at this, guys. Penn's visitation this year specifically had grown 10% and 28% in January and February earlier this year. Now that's turned negative. Those numbers have declined in both October and November to about -6%, -4% year over year. So less people visiting those casinos now this year at this time, Dave, than they were last year. And I want to point to this chart right here that Bank of America also pointed out. So this is aggregated credit and debit card spending. You see those spikes at the beginning of the year. People were spending a lot. Now look, we've turned negative in the purple and blue categories there, discretionary and total card spend, for the first time this year. So Bank of America is sort of wondering if discretionary spending's coming down, is that going to go down in gaming? And I think maybe some other sectors too, right, Dave?
I was shocked to see that graphic. I thought it'd be remarkably consistent throughout this year. And the real question here is gambling recession-proof? And I put that question to Jason Guyot, who's the CEO of Foxwoods Casino CEO, just a couple of months ago, and he said, absolutely not. Gambling is not recession-proof, which shocked me, that type of admission. I would agree. I think the only thing that has proven recession-proof is really the lottery in terms of gambling. So yes, I think this trend will continue as you see people cutting back on gambling in the near future.
Yeah, certainly. And I think obviously with the Fed continuing to raise rates, remaining very committed to getting inflation under control, that's going to be a lot of pain for millions of Americans. They're going to be forced to pull back on spending. And I think a lot of them, even though if they don't want to pull back on their gambling spending, they're going to have to.
All right, my play is a twofer with Verizon and Netflix teaming up. Verizon customers will get Netflix Premium free for a year if they subscribe to another service through its new streaming marketplace. Now, this is all according to the Wall Street Journal. You'll need to buy a year-long or season-long subscription through Plus Play, which allows customers to manage all their subscriptions in one spot. The services included in the deal include NFL Plus, Premium, NBA League Pass, the meditation app Calm, the Peloton app, the language learning app Duolingo, and AMC's streaming service AMC Plus. Now, a recent J.D. Power survey showed 60% of Americans had at least 4 streaming services. That's up from 40% just 2 years ago, hence the need for this. This move attempts to simplify the managing of all those various streaming services. So let's check out the stocks. Verizon just down, well, slightly, about 1%. Netflix also a slight trim. Neither reacted to the story, needless to say, but it is an interesting partnership teaming up in this.
What stuck out to me there, Dave, is middleman between streamers and customers. That sounds like cable, right? And where we've been before in some ways. I understand it's streaming and we're creating a middleman there, but I feel like we're working in a little bit of a circle here. And I'm curious just what consumer demand is going to be for this product. Would I rather do that or just have all these on my smart TV? Do I need Verizon here to help me? I'm not really sure.
For a free year of premium Netflix.
But does it gain you new customers?
How sticky is that?
Does it gain you new customers and extended revenue year over year, or does it just bring you in the first year? Maybe it does.
Investors think no.
Yeah, I think I have a hard time believing that this is going to work out in the long run. Just as someone who I have Fios, I also have a number of streaming services. I think it would be very convenient. I'm not willing, though, to pay more every single year in order to have this luxury. So I get the payoff in the beginning. You're going to get Netflix and a couple other streaming things for free. I don't know, though, if that's going to be enough to make that customer pretty sticky, but we'll see.
Managing them all in one spot sounds appealing to this guy. Coming up, Delta CEO is bullish, raising guidance and describing air travel as robust. We'll tell you what else he's saying next. All right, shares of Delta Airlines, as you can see, taking off today, 2.5% despite the pullback in the market after CEO Ed Bastian projected 2023 earnings could nearly double on, quote, robust demand for air travel. Bastian said the consumers are, quote, prioritizing investing in themselves and experience. Really tells the story of that movement towards spending on experience. The stock, again, up 2.5%. This comes a day after the airline stocks trended down on a warning from JetBlue. The travel demand appeared to be falling below expectations. JetBlue today, as you can see, up just, boy, I can't see real well, down 1%. So it appears to stick that they project that slowing demand moving forward. This is a really strange read. I cannot figure out what to make of this. I don't think the consumer is that loyal to one airline over another. So why Delta is seeing something that JetBlue is seeing something entirely different. And I should manage, apparently United sees robust growth too. They just purchased 200 planes from Boeing. They're hiring 1,800 people at Denver International Airport. What do you make of the discrepancy here?
Yeah, I think that's a little bit tough, and I think investors in the street are having a tough time kind of deciphering the two. What's interesting to me about Delta is the fact that they still see this remaining so resilient, consumers willing to spend. We got the CPI report, airfares still up well above 30% from what they were a year ago, and trying to make sense of the demand there when the economy continues to slow and more people are losing their jobs. We just heard from Fed Chair Jay Powell that he expects that trend to continue. I have a hard time believing that this travel demand, the pent-up surge to travel, is going to hold steady over the next 12 months. But many of the airline CEOs outside of JetBlue remaining very positive about next year. So I don't know, maybe I'll be proven wrong.
Yeah, I'm just trying to figure out what to make of Bastian's commentary. And it wasn't just the interview he did this morning. This is for an investor event today. So he's not about to go in front of all his investors and blow smoke. This is clearly something he's seeing in the data. I tend to line up with him on this. I don't see any pullback when I travel. Every flight is full. Every airport is packed. Every hotel seems near capacity. So, and I will say, based on experience, JetBlue is providing a tremendous product, great customer service, biggest seats. They've got the free Wi-Fi. That's my
It's hard not
my
to love them.
JetBlue
And the
ad.
Doritos and the Cheetos and all the snacks that they had. That's what gets me booking a JetBlue.
That I didn't factor in.
Oh, so good.
Okay.
All right, coming up next, a countdown to the closing bell. Once again, we're still looking at losses across the board. Dow off 67 points, S&P off about 1/3%, NASDAQ also in the red. We'll be right back.
All right, coming up here on the closing bell, you can see the market action in reaction to the words of Jerome Powell and the 50-point basis hike. Let's get to Jared Blickery to show us how that move has gone down. It's always fun to watch how they react to Mr. Powell.
Yes, spoiler alert, crypto and Bitcoin were the big movers, as I thought they might be. But here we're seeing, this is our sector action for the entire day. Communication services, the biggest laggard, down 1.3%, followed by financials, materials, real estate, tech, all those really underperforming. And I just want to get to some of the biggest movers on that 2 p.m. announcement. So from basically 2 to 3 p.m., we saw some pretty big movements. JP Morgan caught my attention. Let me just put an intraday. There you can see that big sell-off after the 2 p.m. announcement right there. Also looking at, for instance, Bank of America, that's down 1.3%, very similar reaction right there. But also the chip stocks. A lot of these chip names very highly levered to the business cycle and to the economy. And AMD is a big standout here. You can see on that Fed announcement at 2 p.m., that took a big leg lower. NVIDIA, also one of the bigger losers off of that move, down 2% for the day. And it wasn't just chip stocks, it was also, we're going to take a look at the industrials as well. And two stocks that caught my eye here, GE and 3M. So it's two of the traditional industrial stocks, both losing more than 1%, 1.5% for GE on the day, and 3M moving about 1% down on that reaction, though off of its lows right now. Coming back to some of our other markets here, I did mention Bitcoin, and guess what? That did have a 3.5% sell-off. Let me put a line chart on here so we can see it a little bit better. And from this high to basically where we are now, that's about 3.5%, 4%. So that was one of the biggest movers of the day. And let me just show you what happened yesterday as well, because we did get that outsized reaction to the upside off of CPI. So now it is back within that range that we saw yesterday. And for whatever reason, seems that crypto, probably the highest levered sector to these Fed announcement, guys.
You know, that's an interesting takeaway. We never know exactly why crypto is trading the way it is and what it means and how investors are thinking about it. I think more broadly speaking, the initial drop that we got following the Fed decision, Jared, was a bit of a surprise to me because Powell remaining very committed in terms of what he has said in the past, nothing that really should have shocked investors.
Nothing.
We are about to close well off the lows of the day, so maybe investors have had a bit of time to digest and realize it wasn't that big of a deal, but still these wild swings always it's a little surprising to me every single time.
I agree. And as I said in my announcement earlier, or in my analysis earlier today, the S&P 500 still in a neutral zone until it breaks out of this range. Still doesn't mean anything in the big picture. So does that mean today's Fed announcement doesn't count? No, we did get a little bit more clarity. I think just looking at some of our leaders here in our sector action, it could have been a lot worse. So having said that, here's our closing bell of the day this Wednesday.
All right, that closes out today's trading day. Again, all three of the major averages ending in the red following that Fed decision that we got, a 50 basis point hike, raising the rates for 2023 to 5.1%. That was a median forecast from Fed officials. Dow closing off 142 points. The worst performer of the three major averages, the NASDAQ, off just about 0.75%. We want to bring in Jake Jolly, Bank of New York Mellon Senior Investment Strategist. Jake, it's great to have you here on set. So lots to digest in terms of what we just heard from Fed Chair Jay Powell. I want to play for you, though, a bite about what we heard in terms of the jobs market and what needs to happen with employment in order to get a better handle on inflation. Let's take a listen.
Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers.
So, Jake, from an investor perspective, in terms of what this means for equities, obviously a more hawkish Fed, something that investors have been a little bit concerned about. What's your big takeaway?
Yeah, so I think there are two things that really stood out for me today. You know, we got the 50 basis points. That was very much expected. But I think what was a bit surprising and we'll see kind of how the market interprets it in the days ahead, was that the summary of economic projections leaned much more hawkish than was expected. So when you look at where the dot plot actually landed, prior to this meeting, the last September meeting, we were looking at most Fed officials thinking it was below 5%. Now most are above 5%. And you got to remember that they made that decision after seeing the last two inflation reports, which were both better than expected. So despite sort of two better than expected inflation reports, expectations are still that rates are going to have to be even higher and hold them for much longer.
And a real emphasis on the labor market, on wage growth, and that services sector. What do you anticipate in terms of terminal rate will get the job done, in the words of Powell?
Well, I think around 5% makes sense, right? Because when we look at sort of what they think of as being a restrictive level, they are looking at core PCE inflation. And right now that's running about 5%. So sort of getting to that level, you're starting to get into positive real Fed funds rate. And that is, I think, where they're going to want to sit and see how the economy reacts.
When are we going to see some movement in the labor market, though? I mean, look, I am skeptical. I am one in that camp of Andrew Levin, who joins us earlier, that thinks we're talking about 6% before we can actually put a dent in the labor market. What do you see?
Yeah, I mean, it's taking much longer than everyone expected, right? And I think as we move closer to 2023, we're looking at sort of the balance of risk, right? The Fed obviously wants to avoid over tightening, but they know, and they've been sort of vocal about the fact that there is a greater risk to doing too little. So that's why as we move into 2023 and we're not seeing the labor market weaken, the Fed's going to have to remain very restrictive in its policy.
So with the terminal rate higher, obviously, than what we had initially anticipated going back to September, what does that mean just in terms of how aggressive you think the Fed is likely going to be at its next meeting? Are we talking 50 basis points, or do you think we might see a bit of a slowing here to 25?
Well, I think that was one of the more hawkish things that came out of the press conference, was that he was not willing to commit to 25 or to stepping down to 25 basis points at the next meeting, right? There was that question. He basically said, we're going to wait until the incoming data. And that sort of, wait and see approach, the market doesn't like that uncertainty. So you did start to see a bit of a down leg when that information was getting processed into the market. But I think the reason we're getting sort of this reaction of, maybe not quite as bad as people would have expected, given how hawkish the projections were, is the fact that we are on the back of two better than expected inflation reports. So on the one hand, inflation does seem to be coming down faster than we would expect. Powell and the Fed is trying to push back on that and sort of temper the optimism, I think.
So given that complicated dynamic, what's your advice for investors in this environment?
Well, looking to 2023, we think that bonds do have the edge in the first part of the year. And the main reason for that is that, unlike the beginning of this year, yields are at just a much higher level than they were. So when you think about sort of the total return from your bond portfolio, the income side is much, much better. So even though we are likely to see some headwinds in terms of rates potentially going higher from here, the total return is looking much better because of that high income that you're getting from your bonds.
All right, excellent stuff. Unfortunately, I have to leave it there. Jake Jolly, thanks for being here in studio. Good to see you, my friend. All right, is it time to pump the brakes on EV investments? Morgan Stanley lowering estimates on U.S. EV penetration. Senior autos reporter Praz Subramanian here with more on that. Praz, is this as simple as supply simply growing faster than demand at this point?
I think it's more about pricing. It's higher prices hitting demand. They're taking down their EV kind of market share forecast down from 13 to 11 for 2025, and then 32 to 26 for 2030 in terms of penetration for EVs. And they say it's higher prices, battery materials, it's part shortages from your ongoing supply chain crisis, so stuff like that. But hey, there is a silver lining. He says Tesla is his top pick for 2023 based on their sort of ability to sell at ICE-like margins. So it's on their EVs at really higher margins, like almost gas-powered cars in some sense. So battery technology, we're talking about a product ramp up like the new Semi, and also, Dave, your Cybertruck is coming out next year, so that's one of the reasons why Adam Jonas
That's a real catalyst. Adam Jonas is a believer in the Cybertruck, is he?
I mean, that's part of the portfolio
All
next
right,
year,
Adam.
Semi and truck.
Well, Praz, when it comes to what Goldman's saying, though, they did mention in their note the risk that Musk does pose, how a lot of the narrative has kind of shifted to why we like Tesla in the first place, to kind of this sideshow with what he's been saying on Twitter, the amount of time that he's been spending on Twitter. How big of a risk do you think analysts view that to Tesla right now?
So Mark Delaney, Goldman, he cut his price target pretty significantly to 235 from 305, but maintained his buy rating because he says the long-term story is still at play, the growth story for Tesla is still in play. But he did say that the company needs to refocus itself on the actual story that it has of making EVs, making them cost-effective, cheaper batteries, new product platforms, and take the sort of the point, or like sort of like the kind of the shadow of Musk is kind of overshadowing everything from the Twitter point of view and his sort of comments on political terms. So I think that they're saying that the market needs to refocus on Tesla as a company, and Tesla has to do a better job of showing that they are more about themselves and not about Musk.
I keep waiting for him to tweet about Powell. He's been very critical of the Fed chair and wanting rates to stay. But he stayed away from it today. Shockingly.
At least for now.
Shockingly silent. Powell, good to see you, my friend. Thank you. All right, coming up, Zillow's senior economist tells us what the Fed rate hike means for mortgage rates. Stay with us. Fed Chair Jerome Powell saying inflation in the housing market could start to cool by the middle of 2023. But will another 50-point hike further punish the housing sector? Joining us now is Zillow senior economist Jeff Tucker. Jeff, good to see you. How will today's decision by the Fed impact the housing sector that the Fed chair said, quote, had weakened significantly?
Yeah, today's announcement was not a surprise in terms of the actual 50 basis point hike. So I think that news of slightly taking his foot off the brakes had been priced in for mortgages and 10-year treasuries already. So it still seems like a small step in the right direction. We've seen that 10-year treasury working its way down from over 4% to 3.5%. And critically for housing, that has brought the mortgage rate down on a 30-year mortgage from over 7% back down to about 6 1/3. That's really major progress in terms of improving affordability for home buyers. And it's a long road for us to get back from this high inflation, high rate environment to a more slow and steady, low inflation, less costly environment. And we are making progress in that direction at this moment.
Jeff, you mentioned the progress that we're making, the drop in mortgage rates. Do you expect that decline to continue? And where do you think rates are headed then, if in fact we do see that decline continue?
I think that is the base case scenario right now. We're seeing a lot of, goods inflation kind of turning the corner. And we have a lot of reason to expect shelter inflation also to turn the corner in the new year. The Zillow Rent Index year-over-year growth peaked back in February. That takes time to flow through to the CPI rent index. So we expect sometime in the first or second quarter to actually see that begin to decelerate on a year-over-year basis. That's the single biggest component in services in the CPI. So putting that all together, I think the base case has to be that inflation kind of continues on this trajectory downward. So what does that do to mortgages? I think that does bring us back into the 5 to 6% range over the course of 2023. The more optimistic scenario is that we make a lot of progress toward the lower end of that range. The less optimistic scenario is that we end up stalling in the upper 5 point something percent range for mortgages.
Yeah, it really is hard to imagine rates getting much below 5. In terms of housing prices, what's your prediction for 23?
Yeah, our forecast right now, looking a year ahead, is for prices to fall by maybe 0.5 to 1 percentage point from now 12 months ahead. Either way, it's approximately flat. I know there are more bearish forecasts out there of more significant price declines. I think the number one factor in our model stopping us from that prediction is the low inventory. The inventory has not built up in a big way. A lot of sellers are just staying put in their homes. So it actually means out there in the market, you don't see a glut of homes for sale. That has kind of helped keep a lid on, some of those processes where prices actually begin to fall rapidly. There's definitely local color to this, of course, where West Coast markets and some of the inland West, like Phoenix and Las Vegas, they've already fallen maybe close to 10% from a peak back in about May or June. And I think they still have a little bit of room to come down. But at a national level, we just don't see this kind of inventory pressure of forced sellers or really motivated sellers. If anything, sellers are motivated, kind of stay put, hunker down, and stay warm by their 3% mortgage that they locked in back in 2021.
Jeff, what does all this mean then for the rental market? Because prices still substantially higher year over year, I guess on a month over month basis. You're starting, the data that Zillow put together, starting to see some improvement. So what does that mean in terms of rental prices, and how long until we see that reflected in the CPI data?
Yeah, we have seen asking rents actually begin to decline month over month in the last, basically this winter, even beyond the normal seasonal trend. So it looks like there's a bit of mean reversion of where that rent growth is cooling down really sharply. That is great news for renters. It's great news for the inflation measures, but it's really at least a 12-month lag from that slowdown in our asking rent index, filtering through to CPI for rent and owner's equivalent rent. It's hard to say, but I think maybe the best case scenario is that February could turn out to be the peak for year over year CPI rent growth. That would just be 12 months after our rent index peaked. There could be a bit of a lag. Maybe it's sometime in the spring. But we do know this is already bringing relief to renters, either getting renewal letters or going out there considering a new apartment to move into this winter.
Yeah, interesting really to see where they're falling the fastest. New York and Seattle among the top 5, not where you typically expect it. Speaking of regions, the Midwest appears to be the best place for first-time home buyers, according to Zillow data. Why so?
It's all about affordability. Affordability has been holding back the housing market, especially holding back home sales volume all around the country. That 1-2 punch of price appreciation and higher mortgage rates means that places like Seattle, New York, Miami, that mortgage is just out of reach for a large swath of home buyers at the moment. So we looked around the country, and where's the last kind of regional bastion of affordability? It's the Midwest. These are places where middle-class families' income is still enough to qualify to buy a nice family-sized home. Nobody likes paying higher interest, even in the Midwest. But there's a lot more folks who can qualify to buy a home there, and where it's still looking like they're just in a good position to buy in those markets. I thought it was striking too that those were some of the same markets you just highlighted where rent is now growing the fastest. These are the markets where young folks setting out looking for a place of their own, whether renting or buying, they're finding more opportunity and kind of in the heartland, in the Midwest, and the Great Lakes regions. So in terms of housing market activity, that's where we expect it to be the busiest in the year ahead.
Jeff, what about the trends of buying with family and friends? That's something that stuck out to me. A lot of us questioned it, whether or not that's a smart financial idea. I don't want you to weigh in on that, but that momentum really, I think, just signals exactly what's going on in the housing market right now and the fact that so many first-time home buyers simply cannot afford it no matter where they are in the country.
That's absolutely right. It comes back to affordability. And this is a generation of Americans, entering their mid-30s now. The core of the millennial generation is very numerous. There are several million extra people in their early 30s and late 20s right now. And they're just as determined as previous generations to get into homeownership, but they're running into the biggest affordability challenge in a generation maybe that we've ever seen, thanks to that 1-2 punch of prices and mortgage rates. So people are getting creative. They're thinking of other ways to get into homeownership. We have seen, some other kind of life milestones are delayed for the millennial generation, things like marriage and having kids. So that kind of creates this situation where there are folks, in their early 30s or late 20s who might think, okay, how about if, my parents go in on a house with me? How about if my friends and I go in on a house together? We've got a place to live. We know that the price, that our monthly rent isn't going to keep going up, like if we stay in the rental market. So it's kind of folks looking for ways to get into homeownership. And I'm definitely reassured that the way that they're doing it is not, what we did in 2005 and 2006 with ninja loans and no underwriting and, balloon payments. Mortgage underwriting is still rock solid and very strict, frankly, for home buyers. That's why people are looking at these methods of, just thinking, okay, who can I buy a house with if I can't just do it alone right now?
I don't know, still sounds a bit risky to me just in terms of owning a home with friends or other family members. But I don't know, maybe I'm the outlier there. Jeff Tucker, great to have you. Thanks so much for joining us this afternoon. All right, coming up, former FDIC Chair Sheila Bair weighs in on the collapse of FTX and also the pressure that's building for crypto regulation. She'll join us right after the break. For the second day in a row, Congress taking on the collapse of FTX. This time, it was a Senate Banking Committee investigating what happened. The committee wanted to talk to FTX founder Sam Bankman-Fried, but he is still currently detained in the Bahamas, so clearly did not make an appearance today on Capitol Hill. But let's bring in former FDIC Chair Sheila Bair to discuss the latest on this. And Sheila, when you take into account everything that's played out over the last several weeks, we had the CFTC, the SEC, the DOJ, all filing charges against Sam Bankman-Fried this week. Just your takeaway just in terms of what has played out and the scale of this fraud, which is what these charges are alleging.
Right. Well, it does seem to be pretty massive. And I must say, I applaud Justice and SEC and CFTC for moving. I think a lot of people were thinking this was going to take months, and it was undermining public confidence in our enforcement processes, because it was pretty obvious. I mean, we still need all the investigations, but it's pretty obvious that a major fraud appeared to have occurred. So I'm glad they finally moved. I think, the enforcement actions are vigorous and powerful, but it's fit to scale in terms of what it looks like occurred at this company. So I applaud them, and I think it's important for others in the crypto space who may be playing around like this. We don't know. It's not an opaque market, but this sends a really, really strong signal, which is good.
Today we had a Senate hearing. Nice to see you, Sheila. Yesterday we had the House Financial Services Committee hearing, and John J. Ray, who's now cleaning this mess up at FTX, was very transparent about what went on, about the level or lack thereof of sophistication. Let's listen to what he had to say real quick.
Okay.
This is really old-fashioned embezzlement. This is just taking money from customers and using it for your own purpose. Not sophisticated at all.
So much of the discussion, as you know, Sheila, has shifted to regulation, whether it's by the CFTC or the SEC. But when it was old-fashioned embezzlement, in the words of the CEO, would regulation have stopped it?
Well, I think it would have. If they'd been forced to register as an SEC-regulated exchange, there would have been customer segregation rules around protecting customer assets, rules around not having affiliates, investment affiliates of an exchange, given the inside information you get running exchange in terms of order flows. So, yeah, I do think it would have helped. Now, he's right. It sounds like it's good old-fashioned fraud. Technology may be different, but we've seen these kinds of scams before. And so, yes, I do think a more vigorous application of the securities regulatory regime on this institution, on this firm, would have helped prevent some of this stuff or nipped it in the bud earlier. But you're right. I mean, there's nothing new. And they do have, and I've been saying this for a long time, the SEC and CFTC already have the vast majority of authorities they need to crack down on this market. They just need to move ahead more vigorously. And I'm hoping now that this FTX debacle will provide the incentive for them to do so, and the political support for them to do so.
Well, Sheila, then more specifically, I guess, what exactly do you think that regulation should look like if both the CFTC and SEC are playing a role in this? And then also just, does the SEC then bear some of this responsibility in terms of what played out if they should have acted sooner? And you're saying they potentially could have realized what was going on much sooner than where we are today.
Right. Well, I don't know. I don't want to second guess. I know they have brought enforcement cases for litigation around what is a security. So there have been efforts. I hope they double down now. But going forward, I think it's clear they have a mandate. And I think there might have been some political pressure too. This guy was working the Hill. He was trying to play the SEC off the CFTC, take authority away from the SEC and give it to the CFTC over this market. So there were a lot of cross currents in terms of what was going on and the lack of a clear mandate for the SEC to move ahead. I think they've got it now. And as I said, hope they do so aggressively. And I would start with protection of customer assets, no affiliations, investment affiliations of the crypto exchanges. Wash trading, they were clearly inflating the value of their own their native coin with wash trades, or at least that's what it appears in the press reports. I mean, that's just basic stuff that is prevented in their prophylactic measures in a SEC regulatory regime with controls and supervision that help prevent that kind of thing from going on. So they've got the mandate now if they didn't have it before. The SEC's got a lot of things on its plate. Just came out with a big batch of market rules. They've got climate. They've got a lot of things. So I feel their pain, but boy, this has got to be top priority. People are getting hurt in this market.
No question about that. I mentioned the Senate hearing today and an interesting back and forth between Senator Elizabeth Warren and Kevin O'Leary. Other people know him as Mr. Wonderful on Shark Tank. Warren is proposing the Digital Asset Anti-Money Laundering Act, targeting the crypto industry. Here is this interesting exchange.
Currencies have been used for drug trafficking since the 60s in the American dollar, when it was thrown out of a Piper aircraft in a duffel bag. The American dollar is also used by bad actors all the time.
Mr. O'Leary, I appreciate your point that everyone tries to engage in money laundering. That's what terrorists do. That's what drug dealers do. And that's what states like Iran and North Korea have done. The only point I'm trying to make is, should the same rules against money laundering apply to crypto in the way that they apply to banks, to stockbrokers, to credit card companies, to Western Union?
So Warren or Wonderful? Who's got it right here?
Well, Senator Warren's right. I mean, same risk, same rules. There's no reason in the world why crypto exchanges shouldn't have the same kind of controls that other financial institutions. We all want to fight illicit financing, terrorist financing. So she's right. I mean, I think a lot of crypto exchanges and firms, there's a good number that do already, not enough. But she's right. Yeah, there's no reason why there should be special rules for crypto exchanges. My gosh, community banks really spend a lot of money on AML, anti-money laundering, anti-terrorist financing requirements. It's costly for them. It's going to be costly for crypto exchanges, but they should be doing the same thing.
In terms of action from regulators, I also want to bring up this headline that we got today. Influencers were charged by the SEC for $100 million. The SEC charging those influencers for stock manipulation scheme promoted on Discord and on Twitter. So on social media, we know a number of celebrities have promoted FTX on social media, which has kind of gotten them in some hot water. A number of lawsuits have been filed because of that. But when it comes to social media regulation, and I guess what more needs to be done to protect the consumer, what do you think can be better done to protect the consumer? And do you think the regulation that's in place today is enough?
Well, I do. I think this is another case where, yes, and good for the SEC for bringing a very vigorous lawsuit against these so-called influencers. It's the same kind of fraud. The same, pump and dump's been around for a long time. The fact they're using social media now doesn't make it different. The SEC got a lot of authority to go after pump and dump. They're doing it now. I think it'll send a strong signal. They may do more. Power to them if they do. But I don't think we need new rules just because the social media is being used for schemes that have been around for a long time.
Former FDIC.
And I do think that's a danger. Sorry.
No, go ahead.
I think that's a danger because, then regulators, well, should we wait for the legislation? No, you should just go ahead. You've got the authority to use it.
Indeed. Former FDIC Chair Sheila Bair, thanks so much for being here. Enjoy the children's book over your shoulder as well.
There you go. One's on Ponzi schemes.
Very nice. Shark scam over the right shoulder there. Very apropos. Coming up.
Sam Bankman-Fried maybe should have read it.
Yeah, no doubt about that. Good call. Competition heating up among streaming platforms. Can they all survive? Our next guest tells us which streamers could cross the finish line. Next. According to Nielsen, streaming has officially overtaken cable in overall television consumption, but among streamers, who will come out on top? Our next guest has an answer for us. Let's bring in Laura Martin, Needham Senior Media and Internet Analyst. Laura, nice to see you. Who is winning at this point, and where are we in the game? Are we in the third inning? Are we in the seventh inning?
So we're arguing that we're in the seventh inning, that the die is cast, that the winners are the Disney bundle, which is Disney Plus, Hulu, and ESPN Plus, as well as Amazon's bundle with Prime shipping on the subscriber side, and then YouTube on the, let's call it advertising, video on demand free side. And that losers include Netflix, Peacock, Paramount Plus, which also has Showtime, and Discovery with HBO Max. We're saying all of them lose. We came out with a piece today saying that the winners can't be displaced, that the three winners will not be able to be unseated, and that 70 to 80% of the total economics will end up in those three companies, which is what we've seen in digital markets. This notion that digital markets are winner take all markets for economics. We're arguing that's going to happen here in streaming. And so those three companies are going to get like 70% of the total revenue.
So Laura, when it comes to Netflix specifically, because I think a lot of people, when they think about streaming, one of the first companies they think about is Netflix. What exactly are they doing that has them, I guess, as one of your losers, quote unquote, to put it, going forward in this space? And then what happens to the company down the road? Do you still think a possible takeover is in the cards?
Right. So what has to happen in 2023? So churn's going up, right? We've created this consumer behavior where people churn out 2 to 3 times out of the typical streaming service, usually around content. Like, for example, Netflix hit all-time high churn right after Stranger Things ended in July. So we're creating this consumer behavior where people are churning in and out of streaming services. So churn is job one for 2023. You have to get your churn down, because the customer acquisition cost means you have to have a subscriber for like 9 months before you get a payback just on your customer acquisition cost. So churn has to go down. Well, Netflix starts at the lowest churn. So that's really hard for them to get their churn to go lower. And then secondly, the other growth driver for revenue is rolling out into new countries. No one else is fully penetrated. So they're all going to report faster revenue growth because they're going to roll out Saudi Arabia, or they're going to roll out Costa Rica, or they're going to roll out Portugal. Guess what? Netflix is already in those countries, so it can't like grow there. It's like a same store comp for them, which means they're going to net lose subscribers, we think, to these other guys that are going to be more competitive with bundling, with their bundles with their theme parks, or with their bundles with their Prime shipping, or Apple with their devices. All those bundles are going to take share from Netflix, which can't bundle because it doesn't own anything else. And if you're rolling out new countries, that helps your revenue growth a lot.
And in your note, you say Netflix has a competitive disadvantage. Is that why? And could they find a dance partner?
They could if they got bought. Like for example, I think it's a confusion why they picked Microsoft, which actually doesn't have very good ad tech for what they need it for. And there's plenty of established players that would have been a better choice. I think assuming that the Netflix guys really are thinking strategically rather than tactically, maybe they just want to sell to Microsoft. So that would make sense to me. Then they would have a bundle because now they have something bigger to offer with Microsoft. But standalone, no, I don't think they can create a bundle. Too late. I mean, these other companies are competing with, whether it's Comcast or Paramount, they have parks, they have films, they have other streaming services, all those are bundle opportunities for sort of everybody else other than them.
Laura, one company we haven't mentioned yet that's in the streaming space is Apple. Where do they land in your thesis just in terms of the winners and losers and what we can expect from the company going forward?
So Apple is the sleeping giant here. I would say they've done a bad job to date of actually the streaming content business. They're spending round numbers $2 billion a year. This is a game where you have to spend 15 or you're not serious. So the only thing I'd say is they make $90 billion a year of free cash flow and they have 1 billion unique users. So if they ever got serious, they would be a juggernaut. They could unseat everybody that I've said can't be unseated because they have $90 billion of cash flow and 1 billion unique users globally, like on day one. So they're like the dark horse. I think it is possible they never decide they need to be in the content business. I think near term, they're going to be focusing on advertising revenue. And content is messy and it's hard to manage the people. As we've seen from the Walt Disney Company's CEO trading off, it's hard to manage creative people. So maybe Apple just stays away from content and just keeps doing 1 or 2 billion a year exclusive to its platform, not really a major streaming player.
Interesting contract with Major League Soccer, but other than Ted Lasso, not a lot of major buzz around their content. If we're in the 7th inning, that means it's almost game over for somebody. Will we see someone not survive this game? Who is it? And before you go, you got to tell me what you're watching right now, Laura. What are you streaming?
Okay, Wednesday on Netflix. Wednesday, I think it's a really interesting sort of pro-feminist point of view and very dark, so I think very interesting on Netflix. And then gaming, yeah. So I think so. Losing can be winning here. So like the investable companies, Curiosity Stream, Chicken Soup for the Soul, WWE, all get bought. Because they have IP, they own library, they own their own content. So that gets bought by a bigger player, Comcast or Paramount, or gets bought, right? Because they're too small to compete standalone. So I think all those get bought. Paramount, I think, is interesting. If Sherry Redstone, who is the controlling shareholder, wants to sell, I think Paramount's a winner. I think somebody would pay a lot of money for those libraries. But if she doesn't sell and she overstays her welcome, it's way too small to compete. It's $12 billion market cap, and you're competing against Amazon and the Walt Disney Company, or Comcast. I'm saying Comcast loses and Discovery Warner Brothers loses. Paramount can't compete with those companies. So they have to sell, and if they sell, they'll get a nice big premium, and they'll be a winner in this world.
Nice to hear a mention of WWE. That stock up 47% this year. It's been a remarkable performer and really an outlier. I highly recommend The White Lotus. If you're not streaming it, Laura, please do. It's terrific. Season 2 just wrapped. Great to have you. Laura Martin, always a pleasure.
Thanks so much.
All right, good news is in store for retirees. New research from Morningstar revealing that retirees seeking a fixed withdrawal rate can now safely withdraw 3.8% from their portfolio over a 30-year period. That's up from only 3.3% 1 year ago. Yahoo Finance's Carrie Hanna joins us with more on this. Carrie, nice to see you.
Nice to see you, Dave. This is Morningstar runs these calculations every year with 1,000 different variables they throw in and look at these scenarios running the computerized models. And this year, they did bump it up to 3.8%. Now, the standard for more than 20 years has been 4%, right? That would be your the first year you retire, and then you gradually bump that up to follow inflation in the years that ensue. Last year, they dropped it down to 3.3%, mostly because of market expectations, because that's a big variable there. So people are looking at portfolios. And when they say that number, Dave, they're talking about a balanced portfolio of stocks and bonds. So it can be anywhere from, 30 to 60% in stocks and the rest in bonds. But that's what they're looking at moving forward. And so, this is a good news, but last year's number was low because the market was so high. And so this year they've been able to bump it up because the future forecast for the market is you may see more upside as we move through retirement. A couple things to think about here. There are a couple of caveats. I talked to Christine Benz, one of the authors of the report, and she said, you got to remember that everybody spends in different ways. And retirees often spend initially more money in their first couple of years of retirement, not so much in the middle. And then a little bit more, it ticks up at the end. So there's all kinds of variables. And the other thing she mentioned is so many people think you need to have a really equity heavy portfolio in order to last so you don't run out of money in retirement, which is what most people fear, right? That's going to happen. And she said, frankly, bonds can really be your friend. And some of the highest rate of withdrawals can be if you have a heavy bond portfolio. So I thought that was kind of interesting.
Yeah, we heard that from a guest earlier in the program as well. What are some different strategies that retirees can employ to lock in a higher starting withdrawal?
Yeah, be flexible, right? If you can decide that you're willing to, if you have a losing year in the market and your portfolio is down, that you're going to reduce how much you're going to take out and just trim your spending. Or if you're willing to say, hey, you know what, I'm not going to adjust up for inflation in years ahead, then you can start much higher than at that 3.8%. But it's a matter of your own, what you feel is going to work for you. In addition, it has a lot to do with your time horizon. Frankly, most of us aren't going to need 30 years in retirement, right? So, and depending on what year you actually retire and start that initial thing, you can tick it up quite a bit higher. I think Christine said it could be, you could start at 4.4%, depending on your age, if you're, quite a bit older. So the point is you don't have to swing for the fences on these things, but you need to be flexible. And I think that's really how you can get it up. But again, Dave, just remember, these are just a guideline. The most important thing the financial planners I spoke to said is, every year take a look and see what's going on, and then you can decide what's the right amount for you to withdraw. But make sure you have enough cash set aside in order to weather some bad markets or a tough market.
Great advice there. Carrie Hannon, thanks so much. All right, coming up, pricing pressures continue to pinch consumers' wallets. We'll break down which cities are dealing with the highest levels of inflation and why after the break. Consumer prices rose less than expected in November, still though up 7.1% from a year ago. Much like Tip O'Neill famously said about politics, all inflation is also local. Here are the top 5 cities where inflation is rising the fastest according to Wallet Hub: Phoenix, Miami, Tampa, Atlanta, and Seattle rounding out the top 5. Let's talk about that with Wallet Hub analyst Jill Gonzalez. Jill, nice to see you. So why are those top 5 cities, what do they have in common? You may be on mute there, Jill.
There we go.
There you go.
Inflation all over the country is based on supply and demand. Right now, it stands at around 7.1%, but in these 5 cities, it's up as high as 12% in the Phoenix and Scottsdale area, more like 10% in most of these other cities. And that really comes down to labor shortages. So look at these places: Phoenix, Scottsdale, Miami, Fort Lauderdale, West Palm Beach, Tampa, St. Petersburg, Clearwater. These are metro areas that are right now in peak snowbird season. So they're kind of retiree havens year round, but even more so now. So that's putting even more pressure on their ecosystems when it comes to the finances. That means that there are more people, therefore more demand, and still less supply because we're already seeing these labor shortages post-pandemic. So that's why these places are even more stressed financially right now when it comes to inflation.
It's interesting, Jill. I wouldn't have guessed that. I guess, but then when it comes to the stickiness of this, the fact that so many people are moving to those cities, the fact that you mentioned snowbirds, I would think that that would then increase over the next several months as it's become more and more attractive places to live. Does that mean that maybe inflation is going to tend to go even higher in some of those cities than where it is today?
Well, the good news is that inflation overall seems to be slowing down. I do think that it will slow down nationwide, but in these particular cities, it's going to take a while to see that same slowdown that we might be seeing in other places like New York or in LA. So I do think that things are going to be slowing down. I mean, a lot of this does come down to the Federal Reserve. We have seen that their aggressive rate hikes have seemingly been starting to slow inflation. Certainly, by no means the amount that you might feel it in your wallet anytime soon. But I do expect that to happen in these cities as well, just not at the same rate that we're seeing it across the rest of the country.
Well, you surprised me, Jill. I was certain that you were going to say it's all about real estate. Number 1, 2, and 3 are the top 3 housing markets over the last 2 years. They have been growing exponentially, it's up somewhere around 20% in terms of their home prices. How does real estate factor in here?
That too. I mean, obviously, these markets are very well sought after, especially after the pandemic. People want more space. People want to be outside, working remotely. People are retiring earlier as well. So we're seeing all of that, which again, brings it back to more people, more demand, and not enough labor to accommodate these growing populations. So even the housing costs, are helping to slow that down. People might be now waiting a little bit with a recession looming, but either way, the populations have grown there over the past couple of years.
Yeah, those stand in stark contrast, though, to 6, 7, and 8, which are Detroit, Anchorage, Alaska, and Baltimore, all 3 relatively struggling economies at this juncture. But I want to get to the cities where inflation is growing the slowest. Chicago, Honolulu, Houston, San Diego, Minneapolis also really stand out. San Diego and Honolulu in particular, 2 of the most expensive cities in the country. What stands out to you about the bottom end of the spectrum?
So here we see cities in a lot of cases that had kind of the least room to grow in terms of inflation, right? Honolulu, one of the most expensive places. Everything you buy there kind of has an additional import tax tacked onto it. So things can't necessarily get that much more expensive there, especially when we're talking about imports. I mean, when everything's coming in, already paying for it, that's kind of what we're seeing here as well. Some of those other places, again, more expensive to begin with, so less room to kind of go. But you are, regardless of where you are, especially in these places, even if you don't see inflation as much, you're still probably paying a little bit more for a little bit less, especially when we're talking about groceries or gas.
No question about that. We saw some numbers skyrocket in produce last month. Jill Gonzalez from Wallet Hub, thanks so much. All right, let's kick it over to Shauna for a look at what is moving after hours.
We have got 3 names for you here, Dave. We got Novavax, Tesla, and Warner Brothers Discovery. Let's kick it off with Novavax because we're looking at a drop of just about 11% after hours. The company saying that it will be offering $125 million worth of convertible bonds, also $125 million worth of shares here. That's putting pressure on the stock after hours. And this comes after what has been a very tough couple of months here for Novavax, to say the least. The stock off 47% in the last 3 months alone. Year to date, we're looking at losses of about 87%. Let's take a look at Tesla here. That stock moving not so much after hours, but I want to point out to the drop that we saw today, off just around 2.5%. Now this drop coming after the price target was lowered at Goldman Sachs, which we have talked about. Their market cap now below $500 billion for today, right around $495 billion. Certainly has been a tough year for Tesla, with shares off 55%, also contending with higher rates, which means it could be a challenging several months here for Tesla going forward. And then Warner Brothers Discovery, that stock off just about 0.5% in extended trading. The company raising the write-off cost to $5.3 billion for the merger. That was much above what was the initial estimate. The initial estimate was right around $4.3 billion, so $1 billion more than what the street had been anticipating. This was disclosed in a regulatory filing, so you're seeing the stock off just about 0.5% here in after-hours trading over the past 3 months. Taking a look at that name, off just about 13%.
A lot of cuts coming their way.
More
Shauna,
cuts, yep.
good stuff. Thank you. My stock to watch for tomorrow is Adobe. The software company releases its fourth quarter earnings after the close on Thursday. Analysts are expecting earnings of $3.50 a share on revenue of $4.5 billion. We should also get an update on its $20 billion acquisition of Figma, which is expected to close next year. Coming up, inflation reshaping fast food menus across the country. We'll show you which fast food chains have hiked prices the most. Stay with us.
Fast food prices are climbing just like almost everything else, but what chains are hiking their prices the most? Yahoo Finance's Brooke Dabama diving into this one for us. And Brooke, what did you find? And I'm sure a lot of people, if they go to those chains, aren't going to be too happy.
Yeah, not going to be too happy. And certainly while the food away from home actually is up 8.5% compared to the food at home, up 12% according to latest CPI reports. So consumers looking to dine out on a dime here. But when you look at just the numbers from the price transparency platform, PriceListo.com, they found that across the board at some of the top food chains, they're actually seeing menu price increases up double digits. Wendy's up 35%, Chick-fil-A up 15.6%, Taco Bell up 14.6%, Burger King, some good news there, only up 2%, but McDonald's actually, surprisingly, Price Listo found down 5%. Now, they gathered the data from in-store visits, phone interviews, and also they collected it from business owners who then uploaded their data onto the site. I was surprised too, Dave. I know. I was surprised too.
It's hard to make sense.
Right? Because we've heard over and over on these analyst calls that they're raising prices because it costs more to transport the goods. Ultimately, the goods at the core cost more. You know, we're hearing chicken costs more year over year, but those were some of the staggering increases. And if you take a closer look at the average item price, those numbers also higher. Wendy's coming in at the most expensive. Taco Bell still can dine on a dime there, about $3.37 for the average item price.
Quickly, any theories on how McDonald's went down?
Yeah, see, I was interested in that too. And based upon what they're telling me, basically we saw some items go down like
I don't have it in front of me exactly, but just certain examples. They said that they ticked down because of the aggregation between the Big Mac as well as the French fries and just different items that they actually year over year was down in price, and therefore they found that the average year over year was down. I was surprised as well.
Yeah, I hadn't noticed those price increases when I do go to those places. I don't know.
Say Wendy's slides right by. Slides right by.
Great to see you. Thanks so much. All right, that'll do it for us on a very busy Fed Day. We'll see you right back here at 3 p.m. Eastern Time for all your coverage for Shauna. I'm Dave. We'll see you tomorrow.